Chapter 1 Problem Solvers Cost Concept Alternative Problem. Hello all. Let's complete a problem solver for the PEP Corp. The focus for this problem is the basic cost concepts. We'll use Buck's methodology to answer the questions. Our first step is to make sure that we read and understand the question. So take a few minutes to look at the data. The relevant range is 5,000 to 8,000 units. As long as production levels are within this range, the variable cost per unit and the total fixed cost will remain unchanged. The problem states that all cost averages are based on 6,000 units. This piece of information is key to understanding all fixed expenses. When dealing with fixed costs, the total amount will equal the 6,000 units times the average cost per unit provided. The amount will not change with changes in the level of activity because it's a fixed cost. On the other hand, the total variable cost will change with the level of activity. Direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead are all product costs, which means that they will be carried on the company's books as inventory until the finished product is sold. SG&A expenses include sales commissions, variable administrative expenses, fixed selling and administrative expenses. All are period costs, which means that they are expensed when incurred and are reported on the income statement. The information provided also shows that there were 7,000 units produced and sold, and that the selling price was $23.50 per unit. Questions A through K are based on the data provided in the schedule. Boxing each question is simple, as a problem to be solved for each case is simply stated. Question A asks that we determine the total amount of the direct manufacturing cost. The concept to be underlined is direct manufacturing cost. As you know, these costs are easily and conveniently traced to a specified cost object. The cost object for this problem is the product being produced and sold. The relevant data includes 7,000 units produced and the direct materials cost at $6 per unit and direct labor cost at $3 per unit. The total average cost per unit is $9. Data relating to indirect cost and selling price are irrelevant. We can now solve the problem. Since 7,000 units were produced, we multiply the $9 cost per unit by the 7,000 units to get the total direct manufacturing cost of $63,000. Question B asks that we determine the total indirect manufacturing costs incurred. The concept to be underlined is indirect manufacturing costs. These costs are related to the manufacturing process and are incurred for the benefit of more than one cost object, or are costs which cannot easily or efficiently be traced to a specific cost object. Indirect manufacturing costs are referred to as manufacturing overhead, or MOH, and include indirect materials, indirect labor, and factory overhead. The relevant data includes variable manufacturing overhead of $2 per unit, fixed manufacturing overhead of $2.50 per unit based on 6,000 units of production, and the 7,000 units actually produced. Costs related to direct materials, direct labor, selling, general, and administrative expenses, and selling price are irrelevant. Since indirect manufacturing costs are a mixed cost, we need to determine the variable manufacturing overhead and add it to the fixed manufacturing overhead. Variable manufacturing overhead is $2 per unit times 7,000 units produced for a total of $14,000. Fixed manufacturing overhead is $2.50 per unit multiplied by the 6,000 units it was based on for a total of $15,000. Solving the problem requires that we add the variable manufacturing overhead of $14,000 to the fixed manufacturing overhead of $15,000 to get a total indirect manufacturing cost of $29,000. Remember that the fixed cost average was based on 6,000 units and as such will remain at $15,000, which is $2.50 times the 6,000 units it was based on. This holds as long as we operate within the relevant range of 5,000 units to 8,000 units. Question C asks that we determine the total product cost. The concept to be underlined is total product cost. Total product cost is the sum of direct material, direct labor, and manufacturing overhead. To get the total cost of each, we multiply the per unit amount by the units produced. The relevant data includes direct materials of $6 per unit times 7,000 units or $42,000. Direct labor of $3 per unit times 7,000 units produced or $21,000. And manufacturing overhead totaling $29,000 as calculated above. All other data is irrelevant. The problem is solved by adding the three amounts for a total of $92,000. For this problem, the amount produced equals the amount sold. Had there been a difference, we would always multiply the per unit variable cost by the units produced to determine the total product cost. Question D asks that we determine total period costs incurred. The concept period cost refers to costs which are necessary to run the business during the specified period. Period costs include all selling and administrative expenses. Period costs are not included as part of the cost of either the purchased or manufactured goods. Instead, period costs are expensed on the income statement in the period in which they are incurred. For this problem, period costs include sales commissions, variable administrative expenses, fixed selling expense, and fixed administrative expense. All other amounts are irrelevant. Since sales commissions and variable administrative expenses are variable, we need to multiply the average per unit cost by the actual amount sold. In this case, sales commissions is $1 times 7,000 units or $7,000, and variable administrative expenses is 50 cents times 7,000 units or $3,500. Total variable SG&A then is $10,500, which is the $7,000 plus the $3,500. The fixed costs are based on 6,000 units and not 7,000 units. Again, because fixed costs do not change with the level of activity. The fixed selling expense is 50 cents times 6,000 units or $3,000, while the fixed administrative expense is 40 cents times 6,000 units or $2,400. Total fixed SG&A costs are $5,400, the $3,000 plus the $2,400. To solve the problem, we add the total variable cost of $10,500 to the fixed SG&A of $5,400 to get total period cost of $15,900. Again, for this problem, the amount produced equals the amount sold. Had there been a difference, we would always multiply the per unit variable cost by the units sold since we are determining the SG&A. Question E asks that we determine total variable cost per unit. The concept here is total variable cost per unit. The per unit amounts for both variable manufacturing costs and variable SG&A are relevant. The selling price and fixed costs are irrelevant. Summing the direct materials of $6, direct labor of $3, variable manufacturing overhead of $2, sales commissions of $1, and variable administrative expenses of 50 cents gives us total variable cost per unit of $12.50. Question F asks that we determine total variable costs. Since we already know that variable cost per unit is $12.50, we simply multiply the $12.50 by the 7,000 units sold to get $87,500. Question G asks that we determine the contribution margin per unit. The contribution margin is a key term for this class. It is the amount remaining from sales revenues after all variable expenses have been deducted. This amount contributes towards covering fixed expenses and then towards the profitability of the company. When discussing the contribution margin, we can talk of it in terms of total dollar amount, per unit dollar amount, or as a percentage. The percentage is called contribution margin ratio. Since the focus for this question is on contribution margin per unit, the relevant data includes the selling price per unit and the average per unit data for all variable costs. All fixed costs are irrelevant. To solve, we total the variable product cost of $11 and the variable SG&A cost of $1.50 to get total variable costs of $12.50. We then subtract the $12.50 from the selling price of $23.50 to get a contribution margin per unit of $11. Question H asks that we compute the net operating income. Determining net operating income starts with sales. From sales, we subtract all variable costs, both variable product cost and variable SG&A. Sales minus variable costs equal contribution margin. From contribution margin, we subtract all fixed costs, both fixed manufacturing overhead costs and fixed SG&A costs. The remaining amount will represent a net operating income or a net operating loss. Sales is determined by multiplying the selling price of $23.50 by the 7,000 units sold to get a total of $164,500. Total variable cost is $87,500 as calculated earlier. It includes variable product costs of $77,000 and variable SG&A costs of $10,500. Contribution margin is the difference between sales and total variable cost, or $164,500 minus $87,500. The contribution margin totals $77,000 and represents the amount to be used towards covering fixed expenses and then towards profits for the period. Total fixed costs are $20,400, representing $15,000 of fixed manufacturing overhead and $5,400 of SG&A. Subtracting the total fixed costs from the contribution margin gives us a net operating income of $56,600. You should note that you could have determined the NOI quickly by multiplying the contribution margin per unit of $11 by 7,000 units sold to get a contribution margin of $77,000, and then subtracting fixed cost of $20,400 to get the NOI of $56,600. Question I asks for the incremental change in manufacturing costs if production increases by 1 unit. That is, by producing 7,001 units instead of 7,000 units. The concept of incremental change refers to the additional costs incurred from producing an additional unit. The only data relevant to this problem is the total variable manufacturing cost per unit. Everything else is irrelevant. The answer is $11. The reason being is that since we are remaining within our relevant range, the fixed cost total and the variable cost per unit will not change. The only change to occur will involve variable manufacturing cost total. The amount will be $11 times 1 unit, or $11. If we produced 100 more units, the incremental change would be 100 times $11, or $1,100. If we produced 200 more units, the incremental cost would change by 200 times $11 per unit, or $2,200. In all cases, the incremental change will always be the additional units produced multiplied by the total variable manufacturing cost per unit, as long as we're operating within our relevant range. Question J asks that we determine the contribution margin ratio and use it to determine the net operating income. The concept here is contribution margin ratio. The contribution margin ratio is determined by dividing the contribution margin by sales. To do this, we can either divide the contribution margin per unit by the selling price or the contribution margin total dollars by the total sales dollars. Either equation works. For our case, the contribution margin ratio is 46.8% and is determined by dividing either $11, which is the contribution margin per unit, by the selling price of $23.50, or by dividing the contribution margin of $77,000 by the sales amount of $164,500. Once the 46.8% is known, it can be used to quickly determine the net operating income. We multiply the contribution margin ratio percentage by the dollar sales and subtract the fixed cost. So 46.8% times $164,500 gives us $77,000 in contribution margin. Subtracting $20,400 of fixed costs gives us a net operating income of $56,600. Question K asks that we calculate both prime costs and conversion costs. Prime cost is made up of direct material and direct labor. It gets its name because these two costs are what is needed to start production. For this problem, the cost per unit for direct materials was $6 times 7,000 units produced gives us $42,000. The cost per unit for direct labor was $3 at 7,000 units produced for $21,000. The total of direct material and direct labor is $63,000. So prime cost is $63,000. Conversion cost is made up of direct labor and manufacturing overhead. It gets its name because these two costs are needed to convert materials into a finished product. For this problem, direct labor is $21,000 as previously calculated, while the manufacturing overhead is the total of variable manufacturing overhead and fixed manufacturing overhead. Variable manufacturing overhead is $2 per unit times 7,000 units produced, or $14,000, while fixed manufacturing overhead is $2.50 per unit times 6,000 units for $15,000. The total manufacturing overhead is the sum of variable manufacturing overhead of $14,000, and fixed manufacturing overhead of $15,000 or $29,000. Summing direct labor of $21,000 and manufacturing overhead of $29,000 gives us $50,000. $50,000 is our conversion cost. Lots of calculations here, but this comprehensive problem covers most concepts which will be used throughout the class. This problem makes a point of showing you that within the relevant range, the total variable cost will change with the level of activity, while the fixed cost will remain the same regardless of the level of activity. The Excel template for this problem can be found on Canvas in Module 1 labeled PS-01A Cost Concepts. Thanks for viewing this video. Good luck.